Well, welcome back, VITA volunteers. And today we'll wrap up session 3. In our last session, we talked a lot about retirement income and capital gains and losses, and that we kind of left off where we're going to talk about pass-through income today and a few other various types of income like unemployment income or possibly alimony. For that. And then we'll finish up today talking about adjustments to income. So let's get started. I will share my screen here. So we left off right here when we talking about K1 earnings. What's a K1? Well, a K1 comes from either a partnership or an S corporation or maybe a trust. Um, those are all separate legal entities and they all have to file their own tax return. But as a general rule, they don't pay tax. What they do is they pass through the items of income, such as profits from a business or interest and dividends or capital gains. They pass those through to the owners of the entity or the beneficiaries of the entity. For instance, a partnership could have 100 partners in it, all that own a percentage of the partnership. And then they have to represent their percentage of the items of income on their own individual tax return. An S corporation is an incorporated entity. Um, but again, it's a pass-through entity similar to a partnership. Um, Often you may have heard of LLCs. There is no tax form for an LLC. An LLC is called a limited liability company, and they either report their income on a partnership return or an S corporation return, or even sometimes just directly on a Schedule C on their individual return. When you see a K1, they're rare. You don't see many. There could be a few of them, but it's only when they're passing through the simple kinds of income that we can do those. We can't do ones where they're really involved in a business, in a partnership, in a construction company or something like that. Those, we can't do those. Here's what we can do is when we get a K1 that's got interest income, dividend income, capital gains and losses, either short-term or long-term, tax exempt interest income, or maybe there's royalty income. And all of these things, we get the K1 and we report these on Schedule E of the tax return. Here's kind of an example of a K1. And like a lot of these things up here where it passes through like ordinary business income or rental income, we don't do those. What we can do is where it's passing through just interest income, dividends, royalties, capital gains and losses. And sometimes where you're just maybe an investor in a partnership or an S corporation, uh, you'll just get these simple or a trust. Could be your grandparents left you money in a trust and they're not distributing the corpus of the trust or the assets of the trust. You're just getting the earnings off of it. And so that could be a kind of a K1 that we might see. Royalty this is a true or false question, but I'll just kind of talk with it. Royalty income is in scope for a VITA program. Usually we see that reported on a 1099 miscellaneous. Remember in box 2, the key here is we can do royalty income as long as there's no associated expenses with it. That's the key. Sometimes you get royalties off of oil wells, but then the oil well partnership passes through taxes and other expenses that you can offset the income with, but we're not allowed to do that. It's just if they've got just plain royalty income, we could do it. Here's another one. I won't stop you to kind of go look back at that, but this is kind of a review. It says David and Monica are both retired and want to file a joint return. David has a 1099-R distribution from a pension for $32,500, and Monica has a form SSA 1099 with $14,000 in box 5. Is Monica's Social Security income taxable? Now, I could make you just stop and say, okay, go back in your 4012 and look at the income limits to where it makes Social Security income taxable. Usually you don't need to worry about this. If you're inputting it into TaxSlayer, it's calculating it for you. But maybe you're sitting with David and Monica's saying, hey, I'm about to take my Social Security next year. How's that going to affect us? And then you might want to answer it. And the answer is that once you're married filing jointly, once your income hits the floor is 32,000. That's the floor for a married filing jointly. And then once it grows to like 44,000, it's 85% taxable. So the answer to this is yes, it's going to be taxable. So that kind of concludes our things about capital income. And of course, we included K1s in there too. Now let's look at a few other forms of income we've alluded to already. One would be unemployment, and we do see this in VITA sites a lot. I told you earlier that a lot of states will report that on a 1099-G. And here in Arizona, they don't really give you a 1099-G. They give you a copy of it, a 1099-G copy that's got all of the information that you need to put in here. For all of you Arizona attendees that are watching this, what you want to be careful of here is don't use the EIN numbers up above here. Use the ones down here in the lower lead. It says the state and federal ID numbers are as follows. So here's where you would go enter them. And I want to just draw your attention to something. This is the tax layer income screen, right? Where you get Form W-2. Here it says 1099-G box 2. That's for state and local income tax refunds. And I told you later on when we get into itemized deductions, I'll show you what we do with that. But this isn't for unemployment. If you go down here, it says Form 1099-G box 1, unemployment compensation. So you're going to click on that, and then you're going to say here, add or edit a 1099-G. We do not deal with repayment of unemployment. Okay, at VITA, that gets a little bit more complicated. So when we go into here, then it's just asking you for the general information that's on that letter. Again, if you're in Arizona, watch the federal ID numbers, and then down here, the state ID numbers. The rest of it, I will tell you, there's usually always federal tax withheld, rarely state tax withheld, but that's almost always federal taxes withheld. So watch for that. So when Colton was laid off, he received state unemployment compensation totaling $4,000 before finding a new job. How much would he report as income? And I think you guys know the answer to this. We talked about what is income. It's everything unless it's specifically excluded. And unemployment is not specifically excluded. Okay, let's talk about alimony. And alimony gets a little tricky. It got easier with the Tax Cut and Jobs Act in 2018. Because in that Tax Cut and Jobs Act, they just said point blank, if you receive alimony, it's not taxable. And if you pay it, you don't get a deduction for it. But prior to 2019, and this got negotiated in divorces, okay? It could have been either or. Generally, the recipient of the alimony would include it in income and pay taxes on it, and then the payor would get a deduction. And I say generally, the reason they negotiate that is generally the payor is the more wealthier one or the bigger earner, right? And in a higher tax bracket, and the recipient would be in a lower tax bracket, and then they go negotiate, to how much the alimony will be just to cover the taxes. But what they were doing was they were achieving the lowest taxes possible. And this is one reason why it changed in the Tax Cut and Jobs Act, because they needed to find some tax savings. And this is one place where they found some tax savings. Okay. Now, after 2019 and beyond, I shouldn't say after 2000, it's really after 2018. So from 2019 and beyond, alimony is not taxable to the recipient, and it's not a deduction, or actually, technically, it's an adjustment. It was an adjustment. Remember, adjustments are above the line. It's really a deduction, but we call it an adjustment if it's above the line. However, you still will see folks who are collecting alimony or paying alimony that got divorced before 2019. And so we have to kind of look at that. As I kind of explained earlier, typically the wealthier spouse would be the one who would pay it and get the deduction because they're in the higher tax bracket. When I worked at CPA firms, a lot of the work they would have us do, the attorneys would get us involved so we could kind of come up with the right fair alimony number that took into account that the lower income spouse had to pay taxes on it. And so we would adjust the amount of the alimony, and that way both are coming out ahead. They're just paying less taxes in general. So, and still some of this might exist. There still may be alimony that's being paid that's prior to 2019. So that's on the intake and interview form. It's asked you, were you divorced? If yes, when? And you've got to look at it. Also look at the prior year tax return. That's a big clue as to how to do things. So now for 2019 and later, it's usually the wealthier spouse that's responsible for paying taxes on the payments. That's why the taxes kind of went up for that. And this now the spouse that's receiving the alimony is actually getting more money for that. Now, don't confuse alimony with child support. It is not the same, and it doesn't matter what they call it. Okay, alimony has its own specific characteristics. Child support is support for the child. Okay, it has never been able to be a deduction for the payor, and it's not income to the recipient. Alimony is still considered as income and expenses as long as the divorce or separation was executed before December 31st, 2018. Okay. So here's the tax layer screenshot to where you would put in either if the taxpayer received alimony, remember this is where they have to claim it as income. This is a pre-2019 divorce. Okay. If it's after that, you just pretty much ignore it, right? So here's where you would input the alimony. And by the way, alimony is not earned income, so it won't help with the earned income tax credit. Okay. If the person who's getting a deduction for the alimony, again, this is alimony paid prior to 2019, the payor who's getting a deduction, they need the social security number of the payee, because IRS is going to check to make sure that if they're given a deduction on one return, that the other return's picking it up as income. There is a workaround. I mean, sometimes these spouses, well, you know how it is with divorces. So, but if you can't get the social security number of the payor, of the payee, you can use this fake number. But then if you use this fake number, you've got to paper file the return, and it's going to take forever for them to get any kind of refund. Again, here's where you would put in the social security number of the recipient, or you could put in this fake number if you have to, and then paper file the return. This is the tax layer screen here. Here's another little wrinkle about this change that happened. Okay, so we've already said you can't deduct alimony under a divorce or separate agreement that was executed after 2018. But also if you modify it after 2000, maybe it was available as a deduction prior to 2019, but then if you go modify it, and that modification could expressly states the repeal of the deduction. So that would be another question you'd want to ask the taxpayer who has a pre-2019 divorce agreement. Have you changed it? Have you modified it since then? And if they say yes, then you've got to kind of dig a little bit deeper to see if there was any really changes. This is right out of your 4012, and it gives all the characteristics that are defined as alimony. This may be a little hard to see, but you could pull it up in your 4012 if there's some confusion. But basically, for it to be defined as alimony, it's got to be required by a divorce or separation instrument. You can't just agree to it, separate and say, well, hey, you're making a bunch of money, pay me $1,000 a month as alimony. It's got to be written in a court decreed document. The payer and recipient spouse don't file a joint return with each other. That you can think how the trick would be there, but never mind. The shifting of income into a lower tax bracket, if you would. The payments in cash or cash equivalents, like checks or money orders. In other words, you can't just give them furniture and call it alimony, right? I won't read all of this other, but this is giving you examples of what is not alimony. Again, we've already spent too much time. You don't see that much alimony in VITA. Okay. Child support is not taxable, nor is it deductible by the taxpayer, so don't confuse child support and alimony. I think we beat that to death now. So here's an example. Tom is separated from his wife, but does not have a legal separation agreement. He's paid $3,000 during the tax year for support of his son, who lives with his wife. Which of the following is true? Child support is an adjustment to income. The entire $3,000 may be considered alimony and adjustment to income. Or child support is never an adjustment to income. Okay, so what do we got here? Less common income. Let's see. Oh, here's where you would put in K1 earnings, would be down here. I think alimony would come up here, other income not reported elsewhere. Okay, so there we go. I think we've covered income. So let's move on to adjustments. And adjustments to income, remember the tax formula I gave you in session 2? And it says total income less adjustments to income equals adjusted gross income. So they just differentiate. An adjustment is still a deduction, but the thing is it's an above the line, so it reduces AGI. And that's important because lots of forms you fill out are basing decisions based on your AGI, such as FAFSA forms, financial aid forms, or student loan payment forms and things like that. So, usually an adjustment is better than a deduction. Okay. So here's where you get to the adjustment screen. Of course, it's under the deduction screen in TaxLayer. And here's adjustments, and we're going to talk about several of these right here in just a second. So here's the adjustment screen, and you see that several are out of scope. If you see anything that says like medical savings accounts, MSA or Archer MSAs, long-term, those we don't do. We do educator expenses. I'm going to talk about that in a second. We don't do anything about armed force reservists or qualified performing artists or anything like that. We do health savings accounts, and we're going to spend a little bit of time today on that. Moving expenses. First of all, since the Tax Cut and Jobs Act, that's the Trump Tax Act, moving expenses are only deductible if you're in the military. And I think the recent Tax Act expanded that to where if you were in the what do you call it? The like Secret Service or intelligence community, right? I don't know why they added that in, but they added that in. But nevertheless, even if they're in the military, you have to be certified for military to be able to do that. So we're not going to cover that in this session here. You can study that independently. We can do contributions. These are like to IRA plans. Qualified plans, remember we use that general term. So to IRAs and stuff, we could do that. We can do self-employed health insurance coverage, but most of our Schedule Cs are really just kind of, side jobs, gig jobs and things like that. And we don't really see much about how you can deduct self-employed health insurance. But if you come across somebody in a VITA program where all their income's coming from Schedule C, talk to the site coordinator about self-employed health insurance because they may qualify for that. And it's a pretty good adjustment to it. And then penalty on early withdrawal, we're going to talk about that. You've got a test question on that, very easy one, but do that. So Here's where you're going to get into adjustments in the adjustment screen. And then again, remember, and there was another income. I didn't really show you the screen, but I told you that alimony, if you're receiving alimony, that's going to be in the income screen. If you're allowed a deduction, that would be here. And this is only for divorces finalized before January 1st, 2019. We're seeing less and less of this, okay? But there's where you could get an adjustment. It's not really a deduction, it's an above the line adjustment. If you have a client who makes traditional IRA contributions, the deductible kind, not to Roth, right? We go in here and we can put those in, and that reduces their taxable income. It's an adjustment. Most of us, we do not do anything with non-deductible IRAs. They can get pretty complex. We do student loan interest. Now, we haven't seen a lot of student loan interest because at COVID, they suspended the payments, but those picked up again this year. So we will start seeing, we'll get these forms called 1098E for a student loan interest deduction. And I believe one of your test questions, one of the tax returns that you have to do, has one of these 1098Es on it too. Then there's other adjustments. I can't really think of where we would do any of those. So I won't talk too much about that. Okay, but let's talk about educator expenses. So an eligible educator, K-12, I was a community college professor and all my colleagues would ask me, hey, can I take that educator expense for? No, you can't. You got to be in K-12. You can deduct up to $300 of qualified expenses. Now, these are expenses, they're your out-of-pocket expenses where you've bought supplies for the classroom, anything to help you teach these students. I don't think I have to tell you that the budgets have been pretty drastically reduced in our K-12 schools. And so teachers come out of pocket, and usually for a lot more than 300 bucks, but it's limited to 300. They have to have worked at least 900 hours during the school year. Now, if they're a full-time teacher, even though they got summers off, they easily meet this 900 hours. So, and it can be an instructor, a counselor, principal, or even a teacher's aide that works in there, as long as they work 900 hours and they're K-12. Now, if they're married, both are entitled to the expense, but don't let this fool you here. It's $300 each maximum. So if one had 400 and the other had 250, you can't take 650. You get 300 and then the 250 of that. Here's the tax Slayer screen where you would go in there. Remember, it's under first deductions, then you go to adjustments, and then you go to educator expenses. And here's where you can put this in. And they tell you it's limited to $300. I think even tax Slayer would limit it to 300, even if you put in 400 here. And again, this right here would be for Tom. If they were married, there'd be another box for the spouse. Okay, early withdrawal penalties. Almost always you're going to see this come on a 1099 INT. And in your tax returns, you've got one of these. So pay attention to this box, this early withdrawal penalty box right here. There is a way that you could enter it manually in TaxSlayer. I have never had to do that. Usually when a taxpayer gets these penalties, it gets reported on a 1099 INT. And when you input the 1099 INT into TaxSlayer, it knows what to do with this box number. So you don't have to do anything more. Here's the form for student loan interest statements, the form 1098E. This is the one I told you we'll probably start seeing more of these in 2025. But here's where you can deduct student loan interest. It's a pretty simple form. You just go into that adjustment screen, student loan interest, and plug in the number. There is a limit, okay? And that limit is 2,500. So like in that previous screen, we saw 26, 28. When you go to input it into TaxSlayer, I would only put in 2,500. That's the max, even if the form said 26. Although I think TaxSlayer will limit it. I'm almost sure that they would. Okay. Now, it had to become from an eligible educational institution. That means an accredited institution. Usually you're going to get this form right here, and you don't usually have to look this up, right? Um, However, if no, I can't really think of an example. I know that there's been some schools that are not accredited and maybe they've lent you money. Usually nobody's going to send you this form if it's not from an accredited institution. So I wouldn't get too hung up on that. Had to be an eligible student. I'm trying to think of who an ineligible student would be, and I can't really think of that. Um, AGI limits apply. So if you're single and your modified adjusted gross income is 70,000 or more, you're not going to be able to take the deduction or adjustment, I should say. And see, we use the terms interchangeably. You know, here I'm saying student loan interest deduction. It's actually an adjustment above the line. So here's the form where you could put it. And yeah, okay, I just told this, I assume. Even if you put in the full amount, like this 2680, TaxSlayer's is going to limit it to 2,500. Okay, get a drink of water and then we'll talk about HSAs. HSAs are called health savings accounts. These are really good deals, okay? Um, they they could be, if you qualify for one, and if your employer, usually they're sponsored by employers, not always, okay, but um, it, they have to be tied to a health insurance plan that has a high deductible. And the purpose of this is it's a savings account. You can put money into the savings account, take a tax deduction, not pay taxes on it. And when it comes out, as long as it comes out for medical expenses, it's tax-free. Or also after you turn 65, I think, or maybe 59 and a half. So it also could serve as a retirement account. But I will tell you that, and this is what it makes it such a good deal. If you read in the papers, when folks retire, one of the biggest underestimates that they've done when they're planning for their retirement is underestimating health cost. You know, copays, deductibles. Yeah, they've got Medicare, but you know, the supplement plans or the copayments and the deductibles or the things that aren't covered or whatever, it takes up a big chunk of retirement income. And here's a way that you can save for it. The limits, the contribution limits, depend on whether the policy, the insurance policy, is covering just one person or the family. So those are the limits that can be put in. But if you're over 55, you can add $1,000 to these limits. Over 26 million Americans now have health savings accounts because what's happening is, and 26 million, I'm guessing that that's, you know, pushing 10% of the working folks in America, right, have health savings accounts. I think one of the things that's pushing it is employers. You know, most health insurance is provided through employers or the government through Medicare and Medicaid, but employers are probably the biggest thing, and the cost has just gone through the roof. So one of the ways, for instance, my wife worked at St. Vincent de Paul, and this was maybe 10 or 15 years ago. Their insurance costs were going through the roof, and they said, look, we're going to do something different. We're going to create high deductible health plans. We're going to start a health savings account. And if you put money in, we're going to match it up to a certain level. They'll give you free money, kind of like a 401k, kind of like that. And the idea is that you have you may have a high deductible in your insurance plan, but then you built up money in the health savings account to pay for that deductible, and then the succeeding co-payments. So that's the concept that's here. So it's a tax-favored medical savings account available to taxpayers, but only available to those with a high deductible health plan. So it enables them to save money for medical expenses and get those expenses, pay for them on a tax-free basis. I will tell you now, there's a big misconception. We're going to get to that in the next section when we talk about deductions. Oh, medical expenses are deductible. Well, here's an introduction to itemized deductions. Medical expenses are only deductible if they exceed 7.5% of your adjusted gross income. Now think about that. If you make even $50,000 a year, 7.5% of that is $3,750. The first $3,750 of medical expenses you have are not deductible. So now if you have a health savings account, though, 100% could be deductible if you built up enough money in your health savings account. So um, once you put money into an HSA, you can invest it for added growth. So especially if you're trying to build this up to help you in retirement years, you can invest it in the stock market and it can grow and grow and grow. And all of those earnings, as long as you take them out and use them for medical expenses, you don't pay tax on any of it. So it's a pretty good deal. And as I said, you can draw it out at any time for medical expenses. You don't have to wait till you're in retirement. Okay. As is the case with a traditional IRA or 401k, the money you put into is income the IRS does not tax you on. You get a tax break for that. Okay, you got to have a high deductible health insurance plan. For a high deductible health plan, the minimum deductible has to be at least $1,650 for an individual or $3,300 for a family in 2025. So it's a pretty high deductible health plan. Okay, the HSAs are owned by individuals. Okay, but contributions can be made by anybody. Quite often your employer is contributing to it, but Aunt Jenny could contribute to it if you want it. And it's as if Aunt Jenny gave you a gift, which is not taxable, and then you put the money in the HSA and you get a tax deduction for it. So, and you can accumulate this money over the years that then gets distributed on a tax-free basis to reimburse you for your medical expenses. Okay, how do you know whether they have a health savings account? Well, on our intake and interview form here, there's a question, but you need to be often these folks, if they're not using it or the employer set it up, and maybe they've been healthy and they just haven't used it and they may have forgotten about it, right? You need to kind of ask them about it to make sure. Now, if they have been making contributions or getting money out of it, they will have received one of these forms right here, or both probably. A 5498 SA that reports contributions, a 1099 SA that reports distributions from the health plan. We need both of these forms, okay? And sometimes when they've marked yes on that box and we get quizzing them, oh yeah, I've been doing that, but I just use my card. They give me a debit card and I just use that to pay the medical expenses. I don't have any receipts. Well, they would have sent them, the trustee would have sent them a report, this 1099 SA, of what their distributions were and also what the contributions were. Sometimes we have to send them home to get that report. Here is, and I know it's hard to see right here, but here's the intake and interview form. It says, do you have a health savings account? Often they don't really know what that is. And if they leave it blank, and see now in this new form, we're telling them, well, just check the ones that apply to you. So we need to go down here and make sure that they didn't have an health savings account. Okay. Of course, sometimes they give you the stack of papers and you look through there and you do see a 1099 SA and you say, oh, okay, well, you should have gotten a 5498 SA too. Oh, I never got that. Well, they're going to have to call up the trustee or the insurance company and get that or get a copy of it. Another way you can tell that they had an HSA is if you get their W-2. This is a W-2 right here. And in this box right here, 12A, if there's a code W, that means their employer contributed money to the HSA, and they should have at least gotten a contribution form. So that gives you another clue to kind of talk to them about it. So here's the 1099 SA that shows distributions from it. It's a pretty simple form. What we have to be careful of right here is Uh, if one of these two boxes are marked, Archer MSA or MSA, it's out of scope. It has to be this box right here that's marked. But here's the main thing that we need to ask them. We get this form, we see here they took out $1,000. And what we have to ask them for is, what did you use the $1,000 for? You know, I mentioned a minute ago, most of these, they just issue a debit card and they could take the debit card down to Lowe's and use it, right? And if they did, then that is not an eligible distribution, right? Now, the trustee, whoever sent this form, they don't know that, right? So we have to ask the taxpayer. Now, often they'll say, oh, I only use this for medical expenses. So then when we're inputting it in TaxSlayer, well, we input what was the distribution, how much of the distribution was used for medical expenses. Because if a portion was not used for medical expenses, they got to pay taxes on it, and there's a pretty hefty penalty that they have to pay as well. Here's the contributions form, and again, it's similar. It looks like the distribution form, mentions it's from an HSA, how much total contributions were made. This is mainly to make sure. Now, often you need to be a little careful here. Is often this form will not include employer contributions. Okay, so sometimes you have to ask them, did you put any money into it? Did Aunt Jenny put any money into it? Or was it just your employer? And if you see here $2,000 and you look on the W-2 and it has a code W $2,000, well, you pretty much know that was just the employer contributions. Okay. To set up an HSA, you've got to work with a trustee, and that can usually be a bank, an insurance company, or anyone approved to set up an IRA. They can be the trustee, they hold the funds, they invest it, they distribute the money. Um, the trustee does not have to be through your health plan provider, right? It can be independent, and that HSA is yours. If you change jobs, even though your employer set it up for you, that HSA is yours. You carry it with you from job to job. Now, if you change jobs and they cover insurance and it's not a high deductible health plan, you can't put any money into it. You could still draw out of it though. That's still your money. And be careful, you only take it out for medical expenses. Okay. So here, any eligible individual can contribute to an HSA. And you've got one of your test questions that asks you about that. In fact, I found it a little complicated because it's asking you in the test question, well, what section of the form do you report this on? I'm thinking, I don't remember what section of the form. Well, just Google the form number and look at it, and it kind of becomes obvious to you how it's reported. Um, an HSA could be established by a self-employed person. Okay, again, it has to be high deductible. And then the individual could contribute money. Contributions to an HSA must be made in cash. You can't take stock that your uncle left you in Microsoft and contribute that. You got to sell the stock first, and then write a check to the HSA trustee. Although I already said this, employer contributions, they're generally excluded from an employee's income, and then they get reported on the W-2 in box 12 using a code W. Okay, on the first one, we first started talking about that, I showed you the limits. Like for a self-only, it was like somewhere around $4,300. If the employer contributes $2,000, that means that reduces your cap. You can only contribute up to the $4,300, and that includes contributions from Aunt Jenny or anybody else too. So you need to be careful of that. So here's an example of that. So, you have a $4,300 annual contribution limit. The employer contributes 1,000. That means there's 3,300 of which could be contributed by you or Aunt Jenny or anybody else. Oh, and as long as you open up this account, I think it's by the first day of the last month, December 1st, then you can contribute the whole maximum for the whole year. It doesn't get prorated among the year. You can roll over these health savings accounts. If you're not happy with the trustee, you can roll them over to another trustee. Usually you want to make sure that that distribution doesn't come through you. It goes directly to the other trustee. Okay. And yeah, and if you roll over an existing one, that doesn't reduce the annual contribution limit. That's a whole separate issue if you roll it over. Is you leave an employer and you've got an HSA that was established by them with a trustee, and you didn't really like how they've handled stuff or whatever, and you want to do it. What you want to avoid, if they give you a check or some other form of payment, like in this example, it was a certificate of deposit, but it doesn't matter. You've got to roll over the amount within 60 days or it all becomes taxable and all subject to a penalty too. And you can only make one of these rollover contributions during a year. Again, you want to do a trustee to trustee transfer. Now, if you do the trustee to trustee transfer, there's no limit on the number of transfers. The limit, I'm going to go back up to the other slide. This limit I talked to you about, only making one, that's a rollover contribution. That's not a trustee to trustee transfer. It's kind of the same thing. The only difference is you didn't touch the money. It went from trustee to trustee, and there's no limit on those transfers. Okay, so we've already kind of covered this, that you can take distributions tax-free, penalty-free, as long as they're for qualified medical expenses. And by the way, what I think we'll talk about qualified medical expenses in just a second. Let's see. Yeah, right here. This is generally any expense that qualifies for the medical and dental expenses deduction on Schedule A, which is itemized deductions. We're going to talk about that. So those examples are unreimbursed expenses when you go to the doctor, a dentist, or a hospital, or buy prescriptions, or things like that. But let's see, no, yeah, that's the general rule for it. A child of a parents who are divorced, separated, or living apart for at least 6 months of the calendar year is treated as the dependent of both parents for medical expenses, whether or not the custodial parent releases the claim to the child's dependency. So let me take you back, right? When we talked about dependents, I said in general, whoever has custody for more than 6 months, they get the dependency exemption. Okay. What this is saying is if the other spouse who's not entitled to the dependency exemption pays or the healthcare cost, right, get to be able to use their health savings account to pay for it. So it's treated as their dependent for that purpose. So in other words, if it wasn't their dependent, if they have their health savings account and they wanted to pay for somebody who was not their dependent, their brother got cancer and they wanted to take money out of their HSA for their brother. If their brother's not their dependent, they can't do that. Okay, this is the example to where if you've got a child, they're considered dependent for both parents just for this purpose, just for medical expenses. This is a general tax concept right here. No double dipping allowed. So this is saying you can't deduct qualified medical expenses as an itemized deduction that are equal to the tax-free distribution from the HSA, right? You put money in the HSA, you got to take it out tax-free to pay your medical expenses. Well, you can't then again use it a deduction and get another tax benefit for that. That would be called double dipping. And that's kind of general throughout the tax law. You want to be very careful you don't put too much money in there in a year. If you put excess contributions in there, it's subject to a 6% excise tax, and that's every year that it stays in there until it's taken out. But if we see that, we're not allowed to do the return. It's out of scope for us. So this is from your 4012, where it discussed the health savings account, and you can get more information as you need from that 4012. Here's a screening worksheet for the 4012, just to make sure you cover all of the information. If you're talking with a client, you might want to have this open and just scan through it, make sure you've covered all the things you need to cover with them. This is the screen in Tax Slayer. It's the Form 8889 where they report information about a health savings account, and you can decide, whether it's the taxpayer or the spouse, what kind of coverage they have, what the contributions were, how many months they were covered under the plan. And I know you can't really read this, but um, uh, down in here, it's going to ask you, and it's maybe here on the next screen, about distributions, total distributions received. And then it's going to say, what are the distributions used for qualified medical expenses? That's the important question we need to talk with them about. Okay. There's some other boxes on here. They're usually rare, and a lot of the time it's out of scope for us. So I won't cover those right now, too. So if you do receive distributions that are received for reasons other than qualified medical expenses, it's going to be included in income, and then it gets reported on line 8 of the Form 1080. And actually, I think that's on Schedule 1, actually, that it goes under. Okay. So if you take those HSA distributions that aren't qualified medical expenses and it gets included in income, remember I told you that there's a pretty hefty tax penalty? 20%. Okay. Unless the account beneficiary, that could be you, or it could be your spouse, or it could be your dependent, if they die, become disabled, or turn age 65. That 65 just kind of cued me to another thing. You generally cannot have a health savings account after you turn. You can have the existing health savings account. You can't make any more contributions after you turn 65. Okay. Now, there is something called a Medicare savings account. Again, I think I know that that's out of scope for us. Okay. Okay, so this is kind of a recap of adjustments. Adjustments are subtractions from total income. We take those off to arrive at adjusted gross income. Okay. Now, federal adjusted gross income is the starting point for Arizona income. So this could be kind of important, especially now we have a new tax law. And when we start talking about deductions, we're going to identify a lot of these deductions, like no taxes on tips or overtime, and an extra a $6,000 deduction for seniors. We're going to get there. But all of those things are below the line. Okay, so Arizona, and we still don't know about Arizona if they're going to what we call conform to federal and make these adjustments kind of align with the federal. So it could be that all of those benefits on federal, you're not going to get them on the Arizona return. I don't know that. I'm just saying we're waiting for the legislature to convene and deal with it. But the starting point for Arizona state income is federal AGI. Okay, what does IRS stand for? Income redistribution. Okay, so that ends this session 3B, what we're going to do. So for session 4, when we start up with that, we'll review the homework. Again, now what I want you to do is go into your 6744, remember the test booklet, answer those questions in scenarios 1 through 6, the ones that we've covered now. Just keep doing this, keep working at it. Just answer the things we've covered. If you see a question in there saying, oh, what's that? We haven't talked about that. Ignore it for now, okay? Go into the three scenarios where you have to do the tax return and input everything that you can that we've covered. So you're building that as we go. And we'll review that at the first of the next section. And then we're going to talk about, we've got two types of credits that we're going to talk about, non-refundable credits and refundable credits. Big difference between those. And it makes a lot of difference to our clients. And that's going to take up at least 2 sessions of session 4 is all credits that we're going to talk about. So thank you for being here. And until the next session, we shall see you then. Let me stop sharing this. And good luck on your test questions and your studying. Also, go review the publication 4012 for all of these things we've been talking about. You should get very used to being able to reference that because you're not going to remember all of this stuff. Learn how to go back, and when you get to the right page, you'll read it and say, oh yeah, it comes back to you really quick, okay? But you need to know where to find it, okay? So until next time, signing off, and we'll see you then.